This week, if cash flow keeps you up at night, then keep listening. We're going to give you 3 things that you should be watching and a free spreadsheet. Welcome to the Profit Cash Growth Podcast. This is the podcast for 6 and 7 figure business owners who are looking to grow a financially successful business. My co-host, Claire Hancock, is a finance director, chartered accountant and entrepreneur. And every week, I'll be exploring guidance and frameworks designed to help you increase your profits, improve your cash flow and grow your business. Do you know what? I think I spend more time cleaning my glasses than doing anything else in my life. Somebody needs to just invent like smudgeless glasses or something like that, don't they? You're going to take up the mantle?
Am I going to take it up the mantle?
Are you going to take the mantle as in like come up with the invention to fix my glasses problem?
No, because I don't wear glasses. So
Okay.
my eyes are 20/20 and I don't even need to think about it.
Fine. Okay. Very good. Very good. What have you got to talk about this week?
Well, we were watching the football last night, the England-Norway match. Brilliant game. A little bit too tense, as always, for England, though. But when we were watching at the start, you commented on the giant flags that they bring out to the pitch all the time when they do the national anthems, didn't you? And you said, I wonder where they get those flags from.
Well, I didn't say that. I said, I'd love to get inside the factory that's got a printing machine big enough to print those because they're half the size of a football pitch.
And then I thought, yeah, do you know what? That is a really good point. Where do you get such giant flags from and how do they make them? So got on the old internet, on the old Claude straight away. And lo and behold, they are made in the one and only China, which surprised me actually, considering how much influence Donald Trump seems to have had on this World Cup, that they are so
reliant
publicly using Chinese products. I just thought it was quite ironic, really.
Well, it's not that public because I didn't know and you had to go and find it out. So it's not like they wrote made in China in big letters in the corner of the flags, did they?
Well, they might as well have. I mean, apparently it's like the world's biggest flag producer is in China. And it's like, it's just amazing, like what you can get big in, isn't it? Like, I know obviously there's a lot of flags, but you kind of think like, is flags that big? And it turns out it is.
It's basically like when we were growing up, the old made in Japan thing. It's like when things were made in China, it was rubbish and everything was made in Japan. And now it's just like, if it's manufactured in China, isn't it?
Yeah.
I mean, where else does manufacturing these days?
So
nowhere.
What have we got to talk about today, Simon?
Well, should we find out on this week's news story of the week? So, this story, actually, you said to me last week that I love a news story of the week and I would take over the whole podcast with news stories of the week. Well, it turned out this week I couldn't find any news stories of the week for both the podcasts we were recording. So I had to scratch the surface a bit on this one and I decided to put forward the news story about Sky buying ITV because I thought this was quite fascinating, really. But all is not as it seems in this deal. So if we tell a bit of a background story behind this, we have just cancelled our Sky, haven't we?
Yes, we have.
Yeah, why did we cancel it? It was your idea.
Because we went from Sky Q, and Sky Q kind of works by like, it's all built around like the TV guide, you record TV programs, and then you've got this section where you just kind of essentially have like almost like a bit of a to-do list of stuff to watch. And one of the things that I found very frustrating about going over to Sky, we've got Sky Stream, going over to Sky Stream was that it's supposed to be like this content aggregator. So it pulls together like Amazon and Netflix and Disney and Paramount. All of that stuff is kind of built into the Sky interface. So you don't have to go into the individual apps to surface stuff and you can put it on your Sky watch list. But every time I'd go into my Sky watch list, I'd actually have no bloody idea if I've got an episode to watch or not. It was so frustrating. I don't understand why there's not a list that just simply says, still to watch, Claire, or new episodes out this week. Those features just don't exist in Sky, and we paid £50 a month for it. And we never watched any Sky content because we watched basically Netflix, but mostly YouTube and a bit of Apple TV. So yeah, we say £50 a month. We bought Freely TV because we don't have a aerial in our house, do we? So we needed internet TV, but otherwise, never look back.
And what's interesting is Sky are not really fighting people on cancellations anymore. Like it used to be this joke, didn't it, that you couldn't cancel your Sky and they would just slash the price by 50%. There's no argument anymore. The lady on the phone to me just didn't even ask me to try and stay, didn't say anything. In fact, she gave me another £10 for the broadband that we have. So we ended up even better off by the end of it. And So you would have thought out the end of all of this that Sky is losing its sort of footing in terms of like, what is it anymore? Like, at the end of the day, most of the Sky stuff was part of a HBO deal they had. It was all American stuff, which they've lost that deal. So they don't even really have a lot of original content anymore. They're kind of this distributor, but they don't do that very well. And it's like, what is the point in them?
I think if you don't, because your background is media, you used to sell media to like airlines and stuff. So if you don't work in that world, you maybe don't quite understand how the TV companies work, because you've got the people that distribute, they're like the TV channels that you watch, but they buy content from content creators.
Yeah, studios.
Yeah,
lots of different, production companies.
Yeah. And so the production companies make shows and then sell them, and the content the distributors or the channels then sell the advertising. So that's where they get their revenue from, is the advertising. And what I think is really interesting, if we look back like what's happened with TV channels, go back like 40 years when there was just the mainstream, it was probably 4 channels 5 years ago, wasn't it? Maybe even 3. All of the revenue was from advertising. There was no such thing as a subscription, was there?
Apart from BBC.
Slightly different. But, for ITV, Channel 4, Channel 5, there was no such thing as subscription. And now everything's sort of moved almost to this like subscription model. You look at Netflix and Disney and Amazon, they work on the fact that you pay to watch this stuff.
Or get it cheaper or free if you watch the adverts, like Prime and whatever else.
Yeah. And therein is the interesting distinction, is now all of the big distributors are they're not moving away from the subscription model. They still have this subscription model where you can pay for this premium product if you don't want to watch adverts, but now all of them have a free version where you can watch adverts. And I think it's really quite ironic that we're now going back
to
like all of the old TV channels have almost been completely eradicated. Online, these new things like Netflix, Disney, YouTube in particular has like taken over the viewing figures and the viewing stats of mainstream media completely. It's like a whitewash, isn't it?
Yeah.
But now these guys have got really big and they're not making their money from subscriptions anymore. They're going back to making their money from ads.
Well, I guess they think that they can make... It's like when you've maxed out your subscription and your business starts to plateau and the investors are saying, where's your next growth coming from?
Yeah.
They think that this is a non-cannibalization second stream, which is, okay, let's get the people that aren't prepared to pay, let's charge advertising and get their eyeballs in, which I guess works. I mean, it's worked since day dot, because newspapers are entirely built on that. They have a 50-50 ad. We used to have like, you pay for your newspaper, but actually 60% of the revenue of a newspaper comes from advertising, 40% comes from the cover price. And it's exactly the same model that ends up with these, isn't it?
And that's what I think is so interesting about this deal that has been done between Sky and ITV, because Sky doesn't want any of the content.
Well,
ITV Studios remains. They still produce content and programs like apparently Love Island and things like that, Coronation Street, all of that type of stuff. What Sky has actually bought is the channels,
the distribution,
and ITVX. Now, what I didn't know until I started looking into this is that the UK is the largest digital ads market in Europe, which is exactly why Sky have gone and purchased this, because they want ITVX, because it's the biggest free viewing app in the UK. So they're obviously just going to cannibalise that massively. I mean, the video ads market is booming. It's 20% year-on-year growth at the moment, and it's 10 billion in the UK alone.
It would kind of make sense, though, wouldn't it? Because not only we don't have the largest population, but we have a very large population of the European countries
of jobless people that sit at home watching TV all day.
Yeah, but most importantly, we're an English language, so we're producing English language content which can be watched across all of Europe. You can't watch German language content in the UK or in Spain or wherever else, can you? And that's the differential, I think, in that. I mean, we've gone well off on a tangent here, but I think it's a fascinating sort of model and makeup. But it's interesting. People talk a lot about like how, YouTube's the future and whatever else. But actually, if you think about the fundamental structure of YouTube, it's actually no different than the fundamental structure of traditional television. As you just said, the distribution channel, ITV or whatever, is the wrapper, but they're not producing the content. In the same way YouTube aren't producing the content, content creators are producing the content.
Yeah.
It's just that the content on YouTube is slightly more amateur, whereas what's happened over... Well, it's not anymore. But, and the difference is with the main channels is they have a certain standard and a bar where things have to be signed off and get commissioned. So they have to be of a certain quality. And this goes...
What I think we will start to see change in the coming years, I think, because when we were ditching Sky, we were like, well, there were some core programs that we were like, what if something like that came out again? We'd want to watch, like Succession, for example. Absolutely love Succession, but that was a Sky program. So if we didn't have a Sky subscription, we wouldn't be able to watch that. So you can watch Succession on YouTube. But you have to buy it like it's a movie. So I think it was like 20 quid. You pay 20 quid and you get the season of Succession. But that doesn't feel... That isn't something that we would do. I don't think we'd ever take a punt on a new TV season and be like, oh yeah, we'll pay 20 quid just to see if we want to watch it and like it. So I do think there'll be this, the TV channels will start to, like Sky and like Channel 4 and people like that you're paying, like you're downloading a movie, they'll start to have some sort of subscription business on YouTube, which will then bring it much more in line with the likes of Netflix. So you've got like, basically this is Sky want to compete with Netflix, Amazon and YouTube essentially. This is their way that they're doing
they're
it.
Trying to get in there.
But how much do they pay for it, Simon?
Well, they paid this is what's really interesting. The group as a whole currently, they believe's worth about 2.8 billion, something like that. They paid 1.6 billion just for the ITV distribution arm. But this is what's ironic. The CEO, Carolyn, of ITV, of what will be left within the group, believes that by selling this off, that the studios part of the group will now be valued at £3 billion on the London Stock Exchange. Work that out. She actually thinks that the value of having the studios just on its own, away from all the rest of it, is going to push the value of it up hugely. I don't know how she's got to that number, but I literally have read it this morning.
No, I agree with you, but I can see... So there's another part to this deal, which you haven't talked about yet, and there's a production company, which is actually like a really good success story in terms of small businesses. It was started by a couple in Britain called Love Productions.
Oh, yeah.
Now, I know Love Productions because I used to work at Bosch Siemens, and we used to do product placement for the Great British Bake Off, who Love Productions make the Great British Bake Off and own the rights to it. So Love Productions make programs like the Great British Bake Off. I think they make the piano, they make all of those sort of style programs. And Sky, instead of paying all cash to ITV, they have transferred them Love Productions as well. So Sky no longer will own Love Productions. Love Productions goes over to ITV because it's a content creator. Yeah. And therefore, ITV have now taken on the rights to some of the biggest programmes, not only in the UK, like the British Bake Off, it's now international audience. So I can see how...
It's a complete pivot for ITV and a pivot for Sky, but it works for both of them in the strategic direction. They're trying to focus. Yeah. And it's all about focus. The lesson here for business owners is this is about focus, isn't it? And if you focus on one thing, you can become really great at it, then diluting your focus.
But also like one thing not hampering the other arm of your business. All of these programs that were created by ITV Studios, obviously ITV as the distributor, they want first dibs on all the programs, but is that the most lucrative market to sell these programs in? The Voice and programs like that could be bought by any channel.
English language,
exactly.
Absolutely.
And so now it also frees up the market. So actually ITV were kind of, as a whole, hemming themselves in a little bit. And you can see that sometimes in businesses where they've got this like I used to work at a company and we used to sell like essentially like electrical components. Yeah. And we used to sell them to people that would essentially put them in a big wall cabinet. They were going to like manufacturing plants. There would just be these cabinets full of all these different electrical components. And an obvious way to grow that business was to build those cabinets for people and deliver them as like a finished product exclusively 100% with our products in them. But we didn't do that because it would have been in direct competition with the people that were already purchasing from us. And so we were hemmed in. And you see that so many times in businesses that you try and expand into these markets, but it competes and you risk upsetting your own customers and all of that kind of thing. So you actually stunt your growth. So it might seem like ITV are getting smaller, but actually I think they're going to go forwards.
Yeah. Gives them a playing field to do that. Now, I was going to do this as another news story one day, but it's perfectly fitting on this. But I bet you didn't know this. There's a load of stuff I've learned today, and there's a load of change that's been trying to be forced through by government with YouTube at the moment to do with our prime channels 1, 2, 3, 4 and 5. Did you know that channels 1, 2, 3, 4 and 5 have a mandate from the government, irrespective of whether they're commercially owned or under the BBC? If you have to have been given those channel positions, they have a mandate, and I'm going to butcher this, but basically they're told what percentage of content they've got to do. So, for example, every one of them has to put a news channel on. They have to cover local events. This is why ITV have the local newses and things like that, because it's mandated at government level in order for them to be given Channel 3 on the TV guide. because effectively what they're saying is to be in that top 5 that you see on the TV guide, they have to follow a government-led mandate around their content that's in legislation, and that remains as part of it. Now, one of the things that those channels are now saying is that, so on one hand, we've got our hands tied behind our back because of this legislation, but on the other hand, because of the proliferation of content into YouTube, we've lost all the benefits we get from that, which is being on the forefront of the page on the algorithm. So what they want to do is they want to force YouTube to show, irrespective of your personal algorithm, the top 5 channels' content on your front page. So you would be forced the news from channels 3, 4, 5, not from the independent content creators that go on YouTube. What's your thoughts about that approach? It's fascinating, isn't it? And this is going on at the moment. This is all going down at the moment. It's a big, because basically the reason I know about this is that all of the independent content creators, especially, it's going to hit the news ones really bad. So there's quite a big news channel called TLDR News. They're quite big. They actually get they probably get like 8 times the views of somebody like Channel 4 or BBC, right? So like for like, they put their YouTube videos, they'll get 167,000 views. BBC will get like 25,000. But they're saying that they're going to be forced off the algorithm, irrespective of whether that's what you want to be top of your algorithm, by those other news channels because of this legislative push forward by the Department for Culture.
I am in two minds about it because the capitalist inside me just thinks, do you know what? People are not watching BBC content because it is dog shit. Like, if you've ever watched ITV local news, oh my God, you like lose the will to live. It's just utter drivel. And
but they're pitching it as a public service, aren't they?
Yeah,
an important public service.
And so there's an argument that if you're going to force something on people, it must be to people's tastes. Actually, there's a clear age divide in the people that are still watching the 1, 2, 3, 4, 5 channels versus who are on YouTube and things like that. And there's a reason these people go to YouTube, because they find what is on mainstream TV dull as dishwater. So if they're going to force it on people, they must find a way to make sure that it is actually speaking to all audiences. However, then there's the bit inside me that is like, actually, I am pro BBC and how important it is to have a impartial broadcaster in the UK, but I don't think the BBC is impartial. But I think it's important that we have impartiality because the general public generally, I would say, have lost the ability to understand when they're being lied to or when they're just being spun a narrative on something that doesn't quite paint the full picture.
This would be the positive side of the spin that those channels in the government will put on it, which is this protects people from being given
misinformation
news that's regulated.
Because
they're all regulated and mandated by the government.
Just regulate YouTube then.
You can't. I guess they can't do that, but they can do these 5 channels.
Content with over X views or channels over X views or something must fall under the rules that any national broadcaster has to fall under.
Yeah. That's not the route. They're obviously choosing the path of least resistance, I guess, which is to control the channels and the media companies they already control.
Because honestly, like if I turned on YouTube, and there's probably only 5 spots at the top, isn't there? And if those 5 spots every time are going to be taken up with the bloody stuff that I'm trying to get off my normal TV, I don't want to be on YouTube anymore.
No, but you just scroll past them. But
we go to GB News and Sky News every time.
Try and make it.
And they're up there, and they don't have position 1 or 2.
No.
And you would argue that, you know, Sky News, for example, is a generally reputable.
And they're not even in the mandate, so it's interesting.
Exactly.
Yeah.
So
anyway, I knew it would rile you a bit. It would rile a lot of people. But it's
you were saying I was a bit too sleepy for this podcast, weren't you?
I thought I'd wake you up with that.
Yeah.
So I knew I'd poke the beast with
right.
it. Right, let's move on to this week's deep dive. So this week, Claire, we're talking about cash flow, everybody's favourite subject, especially this year, where I imagine most people are probably struggling a little bit more than usual because they're paying more cash out in tax bills than they're used to paying.
Yes.
So we're going to talk about 3 ways you should be watching your cash flow today, aren't we?
Yeah. And this came about actually when I was in the office with a more junior member of the team, and they were doing a cash flow forecast for a customer. And it transpired that in the next sort of 6-8 weeks, this customer wasn't going to have enough cash in the bank to pay its VAT bill. And I said, I don't know this customer too well, but I then said, that doesn't feel right to me, because this customer's been quite profitable for the last 18 months.
Yeah.
So then it's a case of, okay, this customer's making profit. It doesn't have large loans going out and things like that. So why is this customer running out of cash? Why can it not pay its VAT bill? And this got me thinking about talking to that employee about the 3 ways that we need to look at cash to understand what's really going on. If you're just looking at one element of these, then you will have a blind spot and you can catch yourself out.
Yeah.
So we're going to talk about what those 3 different things are, what they show you, and then you take that to your accountant and say, this is what I need from you every month. I need you to be giving me these 3 pieces of cash flow information.
Yeah. Got it.
Okay. So the first one is a cash flow forecast. Okay. Now, this is the most simplest one. And I think a lot of business owners are actually quite good at this. To some extent, they will forecast cash that's coming, and we tend to stick to a simple rolling 13-week forecast. 13 weeks because it covers 3 months plus a week, which means you're not going to get caught out by a tax bill or something like that just happened to fall outside
within
your time
quarter,
period. Exactly. So we do a rolling 13-week cash flow forecast. And if you want a template for this, just drop an email to marketing@profitcashgrowth.com, and we've got an Excel template that we're happy to share with you.
Yeah.
So we do a rolling 13-week cash flow forecast every month. If cash flow is tight, then we'll come back to it throughout the next month and keep updating it. And then every quarter, we look ahead for the next 12 months.
Okay.
And that allows us to make sure that there's nothing coming up that's going to cause a problem and we need to react to.
And what kind of things would you be looking at in that further out period of time, that 12 months beyond that?
What do you mean, sorry?
What would you be forecasting and looking out for that would cause them a problem?
Well, we're looking on the rolling cash flow forecast and the 12-month further look out. We're looking at exactly the same thing. It's just the level of detail and the level of certainty we can go to on it.
Yeah.
So on the 13-week cash flow forecast, we should have a really good level of certainty, particularly about the money going out.
Yeah.
The unknown is generally money coming in. So that's where we might then say, okay, what happens if this doesn't come in and you're 10% lower? Those types of questions. Looking further ahead, we use the same sort of process, but everything's a little bit less known, isn't it? Like when you're getting 12 months ahead, you don't really know what your sales is going to be, unless you're one of those lucky businesses that's got really long contracts. You don't know what your sales is going to be. Sure. You don't know what your outgoings are going to be. So
what decisions do you make on that long-term forecast? Do you flat run rate everything? Do you build in some increase in sales? Do you look back at what's gone in the last 3 to 6 months and build in that level of increase at the same rate? Like how do you make those decisions to get as close as you can to a longer-term view?
Yeah, so when we're doing the longer term forecast, what we're actually trying to establish is like where things could go wrong. So what's the minimum required to stay cash positive? So the minimum sales level, for example, to break even from a cash flow perspective. It's that type of information that we're trying to establish. Because, if we're forecasting our outflows, my business, for example, Profit Cash Growth, where actually we don't have, our cost base doesn't fluctuate apart from staff.
Yeah.
90% of our cost base is staff and office. So therefore it's quite easy for us to forecast our outflows with some certainty. And therefore I know what sales we need to hit every month to break even. And then we can say, well, do you know what? Say we need to do 100k of sales a month, but our break even is only 50k. Do I probably need to worry? No, I think we're going to be all right.
Yeah.
It's that type of thing. But actually, if our break even was more like 100k, but our outflows were like 90k, that's going to keep me up at night.
Yeah. Got you.
Okay. So if you don't have a cash flow forecast at the moment, like I say, drop an email to marketing@profitcashgrowth and we'll get our template over to you. But cash flow forecast should be kind of the bread and butter of what most bookkeepers could do. Most business owners might be doing it themselves as well. It should be quite easy to do.
Quick question. Do you trust the numbers your accountant sends you? Or in fact, are they even sending you what you need at all? If your business turns over £1 million or more, you're already in the top 10% of UK companies. But here's the problem. Most accountants are built for the other 90%. They're built for compliance, not for businesses making big decisions on tight margins. So if you've stopped trusting your numbers enough to make confident decisions, head over to profitcashgrowth.com and book a discovery call. Let's get your business back in the room with people who actually understand it. Cool.
Okay. So the second way that we look at cash is we look at what's called a cash flow statement. Okay. And what this is essentially saying is it's looking backwards. So it's looking at what has happened and we're saying how much cash has this business actually generated. So what's the movement in your actual bank balance and where has that come from? So we generally start by taking your profit, and then we take out any things that are not cash related, such as depreciation, accounting adjustments, etc. So we take your profit and then say, okay, after your profit, by the time like you've paid finance, by the time you've taken dividends, by the time you've paid last year's tax bill, all of that kind of stuff, how much cash have you actually generated in this period?
Yeah.
Because you can have a really profitable business, and we see this really, really often. We've got businesses that are profitable, but they're running out of cash all the time. And this is where that comes out.
I spend my life having these conversations with you about lots of our different businesses, and it's just like drives you mad, doesn't it? Because you just want to know. Like when you see a profit, I just want to make that number up somehow in cash in my head. And I guess that's what this does. It kind of produces like that bridge, I guess, from profit to cash that says, here's where the money's currently at. Is it in a holding pen? Is it not? Is it in? Is it out? Is it, do you know what I mean?
Yeah.
And I think it would give me the sense of confidence and visibility in where I'm at with it, and also real visibility to where the problems are or the bottlenecks are.
Yeah, absolutely. And with anything, don't ever look at this 1 month at a time. You want to go backwards. You want to go back. We tend to look at this on a 6-month basis, but we'll always pull in the last couple of years as well, like the for the full year, so we can see what's happening. What is really, really common, and in a lot of small businesses that we work with, they're not necessarily lifestyle businesses, because the business owners are definitely intent on growing the business, but I think it's fair to say that most of the profits they take out as dividends.
Yeah.
So what you end up with is a business that's actually quite profitable, doing good money, but by the time it's paid its tax bill, paid off some loans that it's got, and paid the owner dividends, there's no cash. There's literally no cash generation. They literally just come back to zero year on year.
There's also kind of, if you're a capital intensive business, that you also get these situations. I was talking to a stock-based business who they were only sort of 2 or 3 years old, and they were now like doing £1 million a year or something, just doing fulfillment and selling stuff like Amazon type fulfillment businesses. The problem was with this, they'd made since they started, they'd made £1 million profit, but they had no cash.
Well, it's all gone in stock, right?
Because the £1 million of their money, the profit, is just sat in stock in their warehouse. They had over £1 million of stock. So you have to remember that if you bootstrap a business, so i.e. you don't put a sum of money up to start with, then effectively what you're doing is you're handing over for years your profit just to create that backbone of working capital for your business to then move forward. And it's that thing of like, it's the wild level of delayed gratification in starting a business that's mad, because you probably will never get that money back until the day you sell it.
And this is what we see a lot, like I say, with a lot of the businesses that we work with. They're good, profitable businesses, like 6-7 figures of profit. But by the time the loan payments have gone out, the stock's been topped up, they've invested a little bit for growth, then the owner's taking the dividends out of the business, there's hardly any cash generation. And the problem, if you don't get any cash generation, you don't really get reserves. So you never actually get out of that cycle. And so it's really, really important that when you're looking at your profit, that you're also then looking at your cash generation to say, do you know what, actually, are we going forward? Our profits are accumulating, but is our cash accumulating as well? Are we continuing to, as a £1 million business, you might say we want to get to 200k cash reserves in the bank, but as a £10 million business, 200k ain't going to cut it. But if you're not generating any excess cash, you're never going to get to, maybe the 500k that a £10 million business needs.
Do you think that the vast majority of kind of startup and bootstrapped and like smaller businesses are services businesses, and kind of these heavy stock-based and capital businesses are generally reserved for kind of the either big companies or they need investment capital up front to make them work? Because it's for most people, it would just be an impossibility to run a stock business where you need to be holding £1 million of stock. How do you start that business? Okay,
stock business is a bit different. I'd say you've got 3 types of businesses that you could categorize people into from a cash flow perspective and the problems that they're likely to have. You've got service-based businesses, the worst businesses from a cash flow perspective. I'll come back to why in a second.
I love a service business, my favourite. You can start them with no money.
So you can
know exactly where all your cash is any given time.
You've got
it's in people,
then you've got stock businesses.
Yeah.
And then you've got asset businesses.
Yeah.
My preference is always with an asset business.
Because you can raise finance against it. That's what you're about to say, isn't it?
You can raise finance against the asset. So when you're looking at a business's P&L,
can raise finance against your stock though, can't you?
You can get stock finance, yes, but it's not as straightforward as that.
Okay.
So take stock businesses out of it and just compare asset-based businesses and service-based businesses.
Yeah.
Take the finance element out of it as well. When you are looking at where your money's going constantly, actually asset-based businesses would have higher EBITDA because you either have high people costs or you have high depreciation. So you invest in equipment, software, technology, all of those things that can do work for you, or you invest in people to do the work.
Okay.
It's one or the other. Now, people, they come out your P&L every month. Your cash flow is constantly being drained by salaries every month. Whereas if you're investing in machinery that can be financed, then actually you take a massive amount of cash in your business and put that on long-term finance.
Yeah, and you just spread it.
Yeah. So when you actually look at the cash generated by an asset-rich business, a trades business, for example, I know that it is people related as well, but they've got a large amount of tools and things like that that can be financed up front, HGV businesses, all of those types of businesses.
But that in itself
they're actually easier to run from a cash flow perspective.
But that in itself can be really difficult because they potentially could they've still got to be making amazing profits. Otherwise, the repayments on those size loans would just eat all of their cash and all their profits anyway.
Yes, but generally, if you get the right finance, you can spread that finance over somewhere between 5 to 10 years. So it's a lot more manageable and it doesn't eat away at your profits as much as people do.
Yeah. Interesting.
So we've said with the cash flow, you need to look forward at what you think is going to happen. And then the cash flow statement, you look backwards at what has happened. Those two things will tell you a huge amount of information. This final one is something that is quite unique to PCG. I haven't seen other accountants. It's not a traditional accountancy way of looking at this. But the reason we started to do this is because I think this is just the most simple way that a business owner can resonate with what's happening with their cash. And we just simply look at the bank balance and we explain it. We say, who does that cash belong to? So if you've got a 200k bank balance, how much of that actually is for your VAT bill, your corporation tax bill from last year that hasn't yet been paid, all of that kind of stuff.
I love this because I love this idea of who owns your cash, as you'd call it.
Well, we simply call it whose cash is it?
Like it stops control freaks like me having to have another bank account for their tax and keep moving it out. If I got a report at the end of each month that just was dead clear and said, right, your balance is this, but this is how it breaks down. You own this amount of cash. HMRC own this amount of cash, just so you're crystal clear. You wouldn't need to be moving stuff around into other bank accounts.
No. And we were talking about
most people don't have reporting good enough to be able to do that, so they end up setting up tons of other bank accounts, move stuff
around.
Because they haven't got a finance function that's reporting well enough, and that's more,
So we'll take your bank balance, we'll take out all of the taxes that you owe, all of the short-term stuff, if you paid your suppliers, all of that kind of malarkey goes out of there. But also now the next bit, we'll spin off on a bit of a tangent before we come back to it. We then also take out customer deposits or any money received up front. And then we say, okay, how much cash is actually yours as the business owner? If you settled everything short term and all of your taxes and things like that, do you actually have any cash? And I would say 75-80% of the businesses that we work with are at a cash deficit. What that actually means is they're living off their tax money.
Okay.
If HMRC,
they're already borrowing ahead of their time.
If HMRC didn't give such generous payment terms, because no other business in the world would say, wait till you get to the end of the year and then add 9 months onto it before you pay me my bill. No business in the world will work like that, but HMRC decide to. So on the one hand, HMRC are a nightmare, but they give very generous payment terms. And so I would say that 80% of the businesses we work with are living off that corporation tax money.
Which in itself is concerning, because if the business goes in the wrong direction, the creditors that get hit are the government.
Yes, but also therein lies the issue. If the business goes in the wrong way, you can see how you get yourself in this vicious cycle. If you're living off the tax money,
you never get back in front.
You can never get back in front until you get quite considerable growth. So that is why people get into this trap and they end up in this HMRC debt cycle, because it's quite easy to get extended terms from HMRC as well. And
that's half the problem. Once you learn that it's easy to do it, it's tempting to do it. And it's
Now, I would say that most of our customers don't have cash flow difficulties, but we've got probably a handful of customers that constantly cash is a really make or break battle for them. It's not just a bit of a headache and keeps them up at night and we can move some things around and sort it out. It's constantly, are you still going to be here next week kind of questions going on. And we were talking about this the other day, and I said to you, the one thing that every single one of these businesses have got in common is that they take money in advance.
Yeah.
So they take deposits, or they take money for a 12-month subscription.
Yep. Which everybody would say is, oh my God, it's the holy grail of the business model, isn't it?
It is.
To have all your cash up front, as long as you don't take it out of your business and spend it as the business owner.
Exactly.
Before you deliver the service.
And
then you've got a problem.
That's the problem, because what happened here is that these businesses got to the end of the year, they saw that they'd make loads of profit, and the business owners took all of the profit as dividends. In like the first year that they had a great profit, they took all the money as dividends. And they were like, happy days, life's great, we're making profit, we're taking dividends out of the business. Nobody looked at the cash flow statement to say, actually, did you generate any cash? Nobody looked at the cash balance and said, no, actually, you can't take 100k of dividends because 75k of it's ring fenced for your,
well, the
for your
irony
tax
is
bill.
Those particular businesses, they don't feel like they need your BDIs on their cash flow because their bank's swimming in it. So they're just like, oh, we've got loads of cash in the bank.
Yeah.
So they take it all out, but that cash is, there to serve. At the end of the day, if they make a 10% profit, 9% of that cash goes on delivering the service in 12 months' time or whenever it is.
Exactly. So the events company that we have, for example, they take deposits up front, and then the event might be in the summertime. So they think that they've got loads of money in their bank, and they go and buy new equipment and new assets to rent out and stuff. They get to the summertime when they've actually got to pay the subcontractor to do the job, and there's no money left in the bank.
I mean, you could do this if you were crystal clear on what your profit margin was. You're like, oh, we make about 15%. You could go, right, we've just taken 100 grand in, I can take 15 grand of it out now.
Yes.
And I could do that knowing that I'd be there or thereabouts with the
Yeah,
costs to service those clients when it comes round. But I can't take 100 grand out because I build 100 grand when I make a 15% profit, because I'm about to spend 85 grand of it on delivering the service. Yeah, it's suicide if you get into that situation.
Yeah.
You can't really.
But when we were having that conversation,
why do people do that?
They've just not had
fall into that.
They've not had the information from an accountant previously, so they got into this trap when they were a bit smaller, and
they're chasing the tails.
Yeah, they didn't have an accountant. Their accountant was literally just doing their year-end accounts and saying, here's your accounts, here's your tax bill, and there wasn't any of this, let's have a look at your cash flow, let's see what's actually going on in the business type of conversation. So they got themselves into a trap that honestly is taking years to get out of.
Yeah.
Like 3 to 5 years for each of these businesses to
you
get out of
borrowed
this
from
trap.
your future self. So it's exactly the business equivalent of putting £20,000 on a credit card and buying a car when you don't have the £20,000. Trying to wean yourself and pay that debt back down takes a lifetime. Once you get focused on it, it takes 5 or 10 years to do that or whatever else. And it's exactly the same for a business owner to get back on front, isn't it?
Yeah. And so we've definitely turned a corner and they're going in the right direction, but it's not tough. It's tough. It's tough, and it will be tough for a couple of years for them. Yeah, I just thought it was really interesting because the holy grail, you think as a business, oh my God, imagine if I had so much money in my bank account because everybody's paying me 12 months up front.
Yeah.
But therein lies the problem with it, that if you don't have the right people providing you with financial information, you're going to get yourself into a big hole.
The thing is, the reason they say business models like that are so good, because the holy grail is you build 100 grand and you spend 90 grand on it on advertising to get the next customer tomorrow rather than wait 12 months for it. That's investing the cash back in the business to grow the business. So that when you hit it, not taking it to fund your lifestyle, totally different. So there are ways that it's acceptable to use that cash and spend that cash. Exactly the same as what banks do. They take your money today and they lend out 90% of it to make more money out of it. And that's fine, but it's got to be a carefully calculated decision with your FD or accountant.
And look, I'm not saying these businesses that are in this situation, that they weren't taking obscene amounts of dividends out of the business. They were actually just taking normal salary out of the business, because nobody ever gave them the information to say, actually, that money belongs to HMRC. If you take that now, you're going to have a problem if you don't generate X, Y, and Z by this date. Then so I really feel for these businesses. They got themselves into a hole just simply because they had a typical year-end accountant that didn't really give them the right advice. So 3 ways to look at your cash to make sure that doesn't happen to you. You've got your cash flow forecast, which is all about looking ahead at what is going to happen. You've got your cash flow statement, which is about looking back at what has happened. And then you've got your cash balance and explain whose money actually is this in my bank.
Is the new whose money is in my bank account on the demo report on your website that I've just put up there?
Yes.
Okay, so if you want to have a look what amazing cash flow reporting looks like in a live demo. If you go to the Profit Cash Growth website, on the home page, about halfway down, there's a section that says, here's what amazing looks like. This is the report your business would actually get. And it takes you through to a live demo of exactly the level of reporting across all the parameters, P&L, executive summary, but there is a cash flow element there that really shows you what sterling cash flow report, like this is like the AAA style. Like most businesses, you don't need to do this unless you're a certain size, but it gives you an idea about just where you can get to with this, so you can sleep at night, so you can predict your business, so you can, you know, how to invest, when to invest in your business. So I really recommend you having a look at that, because you'll get lots of thoughts. If you just want a simple spreadsheet, again, email marketing@profitcashgrowth.com and I'll send across the spreadsheet version that you've got, which is a much more simple do-it-yourself
That's just
option.
for the cash flow forecast.
That's just for the cash flow forecast, yeah. Great. Brilliant. I think that's a wrap. Good roundup on cash flow. We've not done cash flow for a while now, have we?
A wrap on the whole podcast, or just a
wrap on the deep dive for now?
Oh, okay. I thought you were missing out on
Not
PCG
wrapping
Extra,
anything.
Simon.
No, not at all. Let's find out what's on this week's Profit Cash Growth Extra. So I've hung on for a few weeks on this one because I wanted to make sure I'd fully tested it. But my PCG Extra this week is I've got one of the new Google Fitbit Airs, which is the band that goes around your wrist, the sort of fitness tracker. I've had one for quite a while, like a really cheap Chinese one, and it was okay and all the rest of it. This is a slight upgrade, and for those that are not aware, this is kind of, I think they're kind of positioning it to take on the Whoop brand. You know, have you seen Whoop?
Yeah, I know Whoop because, I'm into CrossFit, and Whoop has been heavily promoted by CrossFitters for sure, and High Rocks and sort of professional athletes, hasn't it? So
Whoops are very expensive because they have quite an expensive subscription base thing. So you've got this watch, but you're basically paying I think it's quite a lot. I think it's £200 to £300 a year or something for their subscription. It's really, really quite expensive. And the great thing with the Google one is that you buy the watch thing, the band, which is about 80 quid, 89 quid, and you don't have to have the additional bits, but they actually provide an AI coach with it, which I think costs about £8 a month if you want to continue. I'm just trialing it for the first 3 months, which is free, and then you can pay for it. But if you don't have the coach, it does everything you need to do if you're happy to self-serve and get your own readings from it. But it's a brilliant, across sleep, across heart rate, across tracking steps, across cardio. So if you're a basic level of fitness freak like me, you like to go to the gym, do a bit of pickleball and that type of thing, this has been a great sort of mid-level watch. If you're really pushing yourself, the AI coach is probably well worth it, because if you're training for a marathon or something serious, that coach will literally coach you on your vitals every day and drive you towards that goal and the things you need to be doing around your diet and everything else. So do check it out. I think definitely worth the money, the Google Fitbit Air. And as always, thanks for joining us for another podcast. If you feel like you might have outgrown your current accountant, you'd like to work with Claire and the team at Profit Cash Growth, you can go to the website, profitcashgrowth.com. On there, you can book a discovery call directly with Claire to chat about your current business. And if you wanted to run through some of the things that she does around cash flow specifically, again, you can see the report on the website. We can have a chat with her about what that would look like for your business. As always, please rate, review and subscribe. Just follow this podcast wherever you listen, and we will see you again next week.